everyone, and welcome to the April edition of Economy Watch. We are not in the New York studio this month, as you may have noticed. We are around the world in Connecticut, in New York City, in Brussels, and we're here to talk to you a little bit today about the current status of not just the U.S. economy, but also the economy in Europe and in China and in other parts of the world as well. As I mentioned, this month we'll be examining how COVID-19 is impacting economic growth around the world. Is the pandemic accelerating, or are we beginning to see us turn a corner? How will the U.S. Economic growth be impacted in 2020? How will European economic growth be impacted? Of course, how is the Chinese economy recovering now that the pandemic has been contained? And what are the broad implications for the global economy? Is a global recession inevitable? As you saw during the introduction, you can receive CPE credits for joining us today. Please make sure to enter your full name in the space provided. There'll be 3 pop-ups over the course of this presentation. Make sure to click OK on them. And you'll need to stay for the entire duration of the webcast. I'm joined today by 3 of my fellow economists with the Conference Board. Klaus de Vries is joining us from Brussels. Nice to see you, Klaus.
Happy to be here.
Ilaria Maselli is also joining us from Europe, although I'm not too sure if we have her on at the moment. And we have, of course, our chief economist, Bart van Ark, who joins us from just outside of New York City as well. Good morning, Bart.
Hi, Eric. Thanks for having me on this call.
Of course.
And hello, everybody. I'm trying to be here as well.
Good to hear you, Ilaria. Glad to hear that you're on. So we're going to start off by just doing a brief overview of what the COVID-19 pandemic currently looks like. A lot of the economic forecasting that we're doing is really contingent upon the pace of the outbreak, whether or not we've turned a corner in certain parts of the world, how long we expect it to go on for. So let's go ahead and touch on that just briefly. As you can see in this chart, we have a situation where a lot of Asian economies, the overall number of cases that have been documented has stabilized for the most part. And while in the West, in North America and in Europe, we see that the number of cases, overall cases, continues to climb, although not at the same rate as we saw just a week or 2 ago. So there appears to be some progress in terms of the acceleration or deceleration, rather, of new cases, which we can also see on some of the charts on this slide as well. These are the number of new cases both globally. As you can see, for the last several days, it appears that we've stabilized, if not possibly stepped down a touch. This, of course, is fantastic news. The longer that we have a sustained growth in the number of new COVID-19 cases, the more severe the human impact, of course, but also the more severe the economic impact as well. For countries and economies to start to reduce the level of social distancing, to allow businesses to open up, we have to see the number of these new cases decline. And as soon as we can sort of turn that corner, we're going to be in a situation where we're able to re-engage the economy fully and start to move forward. One area where we haven't really seen much data or news is the COVID-19 pandemic in emerging markets. And I think that Klaus perhaps would like to say something about this. Klaus, did you have any comments on what we're seeing in this part of the world?
Yeah, well, I guess we'll come back to that also at the end of the webcast because they are already seeing huge economic impacts, but at least so far in terms of actual outbreak numbers, it seems to be relatively subdued. Of course, not so much in Southeast Asia, but in Africa, Latin America, but also in India, number of cases so far are luckily still relatively subdued.
Wonderful.
I think one thing to add here, Eric, is that also there's a lot of uncertainty on how things will play out in that part of the world, and that uncertainty is, of course, a major issue from an economic standpoint as well. There are some assumptions that maybe just cases are not as bad in that part of the world, partly because of weather conditions, climate conditions, partly because of a younger population in that part of the world. But on the other hand, the healthcare system in many of these countries is much weaker, and therefore there's a much bigger concern that the worst cases will be much more deeply impacted. So I think it's the uncertainty element, in addition to, of course, the risk of adding very significantly to the number of casualties is going to be very large and will impact not just on human life, but also on the economic outlook.
Understood. Well, we're going to come back to emerging markets a little bit later in the webcast, but I want to move forward a little bit and let Klaus discuss some of the global implications for the global economy. But before he does, we actually have we want to lead into this with an audience poll. So we have a variety of options here for you to choose from. When do you expect new COVID-19 cases to peak in the United States? We're just speaking about the U.S. At this point. April, May, June, July, or no vote. Again, these are the number of new cases, new daily cases that we're seeing published currently. So let's close that poll if we can. All right. So I think we have a bit of a split here. It looks like about 44% of the audience is voting for April, so an imminent, hopefully, corner being turned, inflection point, if you will, and about half, or about 42% in May, 12 in June, and then just about 1% in July. So pretty heavy bias here. Bart, did you have any comments that you had on the results on this?
Yeah, I think it's very interesting to see this. Actually, the government estimates, which are based on estimates done by the University of Washington, are now actually getting more optimistic by the day, and actually expect a peak in the United States in new cases, again, to happen by April 11. So that's down from April 15, or more forward from April 15 just a few days ago. However, it's very important that there's one condition related to all of that, and that is that stringent containment measures, that's what I very clearly say, need to remain in place for at least another month after the peak. So it all is going to depend on whether we can keep that peak as early as we are hoping for now and not get it later. So I think that's a very important qualification, and again, has major impacts for the topic of this webcast on sort of, how do we reboot the economy.
And for the economies that we've been analyzing for Europe and for the U.S., and increasingly we're applying this to Asia, we're coming up with different scenarios in terms of what growth may do, contingent upon the answer to this very question. But let's move on really quick. I want to give Klaus the opportunity to talk a little bit about global trade and industrial production. If we could move on to the next slide, please. Great. Klaus, why don't you go ahead?
Sure, Eric. But before I go ahead, I think there was a question from the audience. Your last slide showed new cases already dropping for the last few days. Our opinions are largely meaningless and totally informed by what we hear from the media. I don't know if you want to comment on that.
Sure, we can comment on that. I mean, data is jumpy. We have, it looks like 3 consecutive days in which we've seen more stable cases, which is encouraging. But as economists, we know not to jump to conclusions prematurely based upon just 1 or 2 data points. So while it does appear that we're making progress, I don't think until we have a solid 6, 7, 8 days of stable to declining new case numbers, we're going to be confident that we actually have indeed turned the corner. So let's not jump to conclusions quite yet, but let's be thankful that maybe we have a couple of days that seem to indicate we may be heading in that direction.
All right. Now on the slide that you're seeing on the global trade and global industrial production, these are monthly indicators. I think it's useful to sketch a little bit of the background, so where we're coming from. 2019 was obviously a very weak year for global trade. It was really historically low growth, actually, especially if you compare it to GDP growth, which was also low, but not not in recessionary territory in that sense. Now, of course, this had a lot to do with the confidence shock that was already building in say in 2018, especially in the second half of 2018, when the trade tensions between the U.S. and China really got quite heavy, and tariffs were being slapped on each other. Now, when we came out with our previous forecast in October, we were seeing some tentative signs of improvements, and we were also arguing that 2020 was likely going to be slightly better. There were also some signs of easing in the trade tensions, actually culminating in a preliminary, but still a deal between the U.S. and China on some of the perhaps smaller issues, but still, I mean, it pointed to some improvement, and we could see those in the data also. But then, when in January the virus hit in China, and at the end of the month, the Hubei province was put in lockdown. I think that already shows in the statistics here that we have the data up to January for now, and we already see a huge drop. So this is actually before I guess before most of the global economy, we'll have that in a slide in a second, before most of the global economy went into severe economic restrictions. So I think that this doesn't bode well for what's
Just a quick question. How does this compare to 2008 and 2009 in terms of the kinds of impacts that we saw then?
That was also, it's called the Great Trade Collapse. It was also a serious fall off in global trade. But the WTO, the World Trade Organization, actually just an hour ago came out with a new forecast for this year, and they expect it to be much worse actually than 2008, 2009. Their optimistic forecast was looking at minus 13% for this year trade growth, all the way down to minus 32% in their pessimistic scenario. So.
Why don't we talk a little bit about how the individual economies are performing? I know you have some TMI data you wanted to discuss as well.
Yeah, so again, the picture here was 2019 very weak, especially in Europe. Germany had a very, in Europe there was an industrial recession actually, and it was slightly improving towards the end of the year, as I was saying. Also January, February were pointing to the view that, look, 2020 is going to be better. And then, of course, the shock came in March in the European economies, and then also in the US. You can see that actually. China, of course, was the first to have the lockdown, and is also the first to start to slowly ease the restrictions. You can see that in the data here. That was a huge drop off in February in the PMI, and there was some improvement in March. And I think just to interpret these numbers, it's important to realize that this is a diffusion index, so it sort of weighs the underlying components. So a value of 100 would mean that all the underlying respondents see the situation improving. A value of 50 would sort of give a balanced panel of people saying it's improving or it's the same as last month, and 0 would mean everyone's saying it's worse than last month. So.
Why don't we talk a little bit about the lockdowns that we're currently seeing? You put together some really interesting data here, Klaus, and I think the audience would really like to walk through. I haven't seen this before. Why don't you tell us a little bit about what we're looking at here and what this means sort of for the future in terms of the implications for economic growth globally?
Sure. So the Oxford University actually has this nice dashboard where they track for about 80 economies actually how strict are the government restrictions on the economy. So they look at things like, are schools closed, is it across the country, or just is it targeted in a certain area, are workplaces shut down, and all they look at all those kind of things, and they come up with a sort of measure between 0 where it's totally free and 100 where it's completely restricted. And what I did here is I basically aggregated all these measures of all the countries that are in the database, aggregated them up to the global economy. I think this clearly shows you also why it how it sort of has escalated over the last 3 months. So you can see, I think you can see basically two waves. The first wave was in the end of January when China a large part of China went into lockdown. Then towards the end of February, early March, and onwards to mid-March, there was a second wave when Europe, much of Europe, and also the US went into lockdown. And now we're sort of, for the global economy, we're reaching almost 100%. So I mean, this tells you pretty clearly that that also the economic contraction is very likely.
But it looks like we've sort of leveled out here and peaked in terms of the stringency index. So China, as you said, is starting to open up. We're seeing Wuhan open up to a certain extent. If indeed we have hit this sort of peak new case numbers, we may start to see additional countries start to reduce some of the restrictions. Austria, for instance, I believe just sort of moved things forward, it's opening shops up as well. Speaking of what direction we're going in terms of unlocking the economy, I want to give Bart Van Ark a little bit of a chance to talk about the status of the U.S. economy, some of the forecasts and scenarios that we're envisioning. Bart, why don't you go ahead and share your thoughts a little bit on this with us?
Sure. Thanks, Eric. So yeah, so we're now beginning to get the first numbers in that really are reflecting the beginning of the pandemic. These numbers here in this chart, it's particularly the top line, the blue line I want to focus on. This is the expectations part of our U.S. Consumer Confidence Index. And you can see this line coming down fairly rapidly in the last month. This is the reading for March, and the forward-looking perspective of consumers went down from 108 to 88. Now, we've seen some of this before. Look at the financial crisis, for example. However, this decline happened in just 1 month. And secondly, this was all registered before mid-March. Now, remember, the global pandemic was only announced by the WHO by March 11th. So in our view, this is just the beginning of a much larger decline. So the speed by which this has happened, if you compare that to the global financial crisis, is much, much faster. We expect this to continue, certainly for the later half of March into April. And I think we can go down quite significantly, of course, all depending on how quickly we can open up the economy. But there's this first signs of things that are not looking great. The orange line, which we're releasing tomorrow, our Consumer Confidence Index, so keep track of that, of course. Sorry, our CEO Confidence Index, which is the orange line at the bottom. So keep track of that. We're publishing that one tomorrow, which also has some really interesting readings and are worth looking into. Now, if we go to the next slide, Eric. We actually also are looking at the impact that these expectations of consumers has on different regions in the U.S. economy. So the biggest impact, the biggest declines that we're currently looking at, we see in the Middle Atlantic, which is on the top right side. That, of course, includes New York State, and also in the Pacific regions. That's where we see the biggest declines happening. We also see fairly big declines in the southern part, West South Central and East South Central. And that is that some of these areas are actually hotspots that include oil-producing sectors. And they're, of course, grappling with all the issues of the oil price declines that we're facing. But there are a few bright spots where we see smaller effects, particularly sort of in the Midwest. But we do expect, again, this is just the beginning, and we'll see this issue sort of spreading across multiple regions. So there are different effects across regions, but we'll see them spread out over time. If you go to the next slide. We also have been looking at the jobs report that came out on last Friday. Again, that jobs report is for the second week of March. So this was just at the time that we were heading into the global pandemic. So we overall saw a job loss of 700,000. This has been widely announced in the media. But this chart is looking at where the biggest impacts are. And you see a very unequal impact. In fact, about 60% of the job losses were just in food service and drinking places. They lost 417 of the 700,000 jobs. So again, we'll begin to see this spreading at least over the next sort of 4 weeks into April, and begin to see how more and more industries are beginning to be impacted by this. So if we go to the next slide, as we said before, if you do an economic outlook at this point in time, we can't give you one forecast. It's just impossible to do. We need to really begin to think about multiple scenarios. And we have been doing that by basically moving from traditional expenditure-based forecasting. We'll show you some numbers on that. So this is really looking at, consumption and investment and government spending and things like that, to more of an industry-based projection. So that is looking at what is happening on a month-by-month basis in different industries and different sectors of the economy. So we developed a system like that that makes it also a little bit more flexible. In the next slide, which I'm going to skip over very quickly, Eric, but I think you may want to show it. This is an eye chart, obviously, but we're doing this sector by sector. We're actually expanding it to 71 sectors now. And just for members who are on the call, conference board members on the call, this model will be made available by us online in the next week or so that companies can begin to play around with your own industries, your own sectors that you're in, and begin to make these month-by-month assumptions. But obviously, we have no time to go through that in detail, so let me take some time to take you through the various scenarios. We're currently working on sort of 4 scenarios, and what I'm saying here, I'm also sort of a little bit of an introduction in Europe. Our European colleagues have been applying the same kind of model, but I will explain this in a bit more detail here for the US. So there's still a quick recovery scenario possible. If peaking would be happening of new cases that we discussed before, if that peak would happen in the next couple of days, there is a possibility that parts of the country can begin to gradually, slowly open up by early May. And if that's true, you can have some economic activity resuming. And if you are, again, able to keep an escalation under control, if we keep social distancing in place, it's possible that the economy can recover. Now, recover doesn't mean that we're going back to where we were, but at least we'll be on an upward path sooner rather than later. Another possibility is that we will see a much deeper V-shape. We have definitely seen a much harder hit in March already than what we were expecting, because a lot of happened in early March already, so the second half of March is going to look disastrous. But it also means that we'll probably get a deeper contraction continuing into April, and everything in an economy that goes down will come back up. So typically, economists would say if it declines very rapidly, it of course will recover. Now, of course, there are many uncertainties about this, because how rapidly, how fast can we really recover? And that is the debate. How steep is that V going to be? Is it very sharp, or is it just going to be significantly flatter? The third scenario is the risk of a V-shaped scenario. The risk of the V-shaped scenario, of course, is that we're opening up too rapidly. That we're actually saying, let's go, let's open up, and we bring people back to work, and we go out again to the restaurants because we think it's all fine. The summer may be arriving, and maybe the number of cases will go down a little bit because of that, but the problem is still there. And once we get into the fall, it will come back, and we will have to go back to stringency measures. So now you get a little bit of a double U-shaped scenario. I saw somebody asking that question online about is this happening in China right now. Yes, it may be. There's concerns in Asia that it may be coming back. For example, Singapore in the last few days has increased their measures again of stringency because they see more cases arising. So there's a real risk that a V turns into a W, and we play that model out as well. And then the final scenario is a more U-shaped recovery. This is actually the positive scenario in the sense that we'll be able to flatten the curve. You all know this, that if we are able to reduce the peak but spread it out a little bit over time, we will save the healthcare system from bigger trouble. But of course, the economic recovery will be much more slower. It will not be V, but a more U-shaped kind of nature.
You know, Bart, I know that this changes from day to day in terms of what probabilities we assign to each one of these scenarios, but what are you thinking currently in terms of which one of these is most probable?
Great segue to the next chart. So let's go there, and I'll try to answer that. You see those 4 scenarios playing out in this chart, right? So the quick recovery scenario, that's the blue one. You know, the first few months they all look the same, but then you see the blue one beginning to recover already sort of by April into May. You see the V shape, which is the orange one, but then you see the red line, which is giving you the W that we were talking about. And then there's this more spread out U-shaped scenario. What is interesting about all those is that all of them will show us a level of economic activity by the end of the year, which is below the level of economic activity by the end of last year. So whatever happens, even in the most optimistic scenario, we will not be able to really see the economy get back to the level of economic activity before. And if you look at the year-over-year change, of course, we are losing so much already in the first few months of the year and into the second quarter that, you know, even a quick recovery scenario would now give us a decline of minus 3.6%. And even that number is unprecedented. We haven't seen that in the global recession. We have not seen that. We have only seen that for the first time in 1946, which was immediately after the Second World War. Now, you're asking me which one is most likely. As I said, I think quick recovery, it's possible, but it really would mean that we have to see these cases coming down quite significantly, and that we are able in a responsible way to slowly start up the economy. I'm not so sure that is really possible. I think there are a lot of assumptions underlying that. The V-shaped scenario, again, is I think what we see in most of the forecasts that are around. Again, the question is, how sharp is that V up? If you ask me, I think it is more likely that we will move into a U-shaped gray type scenario, which means that maybe the bottom is not as big because maybe we are actually able to think about some measures that would allow us to get the economy going, but it will be a slow start. But by the end of the year, we may then actually be at an economic level that is still below what it was last year, but at least we'll make some mileage. Still, even in that scenario, the economy would have declined by as much as 6.5%. So you see two of our four scenarios are looking at about a 6.5% decline year over year. And I frankly think we're probably going to end up somewhere there. And let's not hope it's going to be more. And if we're lucky, it's going to be a little less.
And of course, the number of the unemployment numbers associated with each of these scenarios is a little bit different as well. The 15% that we've been quoted on in the media and also here among the audience is the one that's associated with the fall recovery U-shaped scenario.
Yes, that's right. I think, of course, the longer the recovery lasts, the more sectors are going to be impacted by this, the harder it will be for companies to hold on to their workforce. So this is the price of the U-shaped scenario. It's a gain in terms of helping us to recover the impact on the healthcare system, but it's a price in terms of the gradual increase in unemployment. So that's why we see the sort of 15% unemployment rate that would be arriving at us, and probably we will keep that for the rest of the year in the gray scenario. There's a lot of good questions there. We can't deal with all of them. But I think there's one good question is, what about the L-shaped scenario that everyone is talking about? And why is that not here? Well, to me, the L-shape is really more of a longer-term outcome. Every contraction of the nature that we're seeing today will lead to some recovery. It's hard to see no recovery from that huge decline that we're experiencing now. The question really is, once we go into 2021, are we able to actually fully recover, or are we going to permanently be on a slower growth path? That would be more of an L-shaped scenario. I think it's a little early to really sort of make any predictions about that. I think it all depends on how the virus is developing, and more importantly, it all depends on how we are going to respond, how our government leaders are going to collaborate, and how we're going to think about that new normal. So it's not impossible, but I think an L within the year 2020 is unlikely because we're declining too much, and we will see some recovery.
All right, why don't we talk a little bit about the supply side and demand side of this sort of shock and how that...
Yeah, there's a lot in this slide, and because of the time, I'm not going to go through very extensively, but I just want to say that sectors are being impacted in different ways. At the moment, this is really a supply side crunch. Yes, we'll see huge impacts on consumption, but that's really not because the consumers didn't want to go out, it's because the consumers cannot go out. And of course, by now they realize that they shouldn't go out. So at the moment, this is a supply-side shock really generated by any industry that is vulnerable to the social distancing measures. Obviously, recreation and accommodation and restaurants, but also shops and retail and everything where you go as a person. On top of that is, of course, the oil sector that I mentioned before. But over time, we will begin to see more and more effects. The result of that is that the supply shock will gradually move to a demand shock or a demand element, because the longer this lasts, the more our strong household balance sheets, all of us having jobs with low unemployment at 3.5% is going to hit us, and it's going to be harder and harder for consumers to actually, even if things open up, to really go out and shop and spend money, because we have lost a lot during this crisis. So gradually this will move from a supply side shock into a demand side shock, and again, that will determine the shape of the recovery. And that actually leads us to the last slide for the US section. And that is really, what does this mean now for the expenditure side? So at the moment, this really is a consumption issue. And you see how in these various scenarios, by the way, these are quarterly numbers annualized, so the declines that you're looking at are 4 times as big as what they sort of really are moving from one quarter to another quarter. So let's not exaggerate this, but still, these are big declines. Consumption declines of 10% are possible in the second quarter. And again, depending on the scenarios, we'll see consumption recover. Where we see less recovery, unfortunately, is going to be in investment and spending. Because whatever happens, whatever way we're coming out of this, companies are really burned at the moment. They will see huge impacts on their revenue side. They have to go through major cost cuttings. Their profitability will be hugely impacted for the remainder of the year. So we do not see a lot of V-shaped type recovery in investment in any of those scenarios. If we're lucky, we're going to get back to positive investment later in the year. It all has to come from consumption, and you can see it really is going to make a difference on how the path of that recovery is going to be. And that's why we need to sort of keep tracking that very well over time. Now, there's much more underlying our expenditure scenarios, which we will be publishing on our website tomorrow. But I think those are the two most important elements of this.
Great, thank you very much, Bart. We want to move into Europe, but before we do, we're going to do another audience poll question. If the peak of new COVID-19 cases were to be decisively passed before the end of January, would your company's revenue be back to early 2020 levels within a month, 1 to 3 months perhaps, 3 to 6 months, 6 months to 1 year, 1 to 2 years, 2 to 3 years, or in excess of 3 years? What we're basically trying to understand is how long would it take your firm to get back to where it was before this pandemic actually took off? Let's give the audience just another moment or two. There's a lot of different options here.
A lot of different options, but also a great question because it will help you to shape out what we're currently expecting in terms of the recovery taking place. So it's really interesting.
Let's go ahead and lock that poll if we can. All right. So it looks like we're locked in here. It looks like a pretty, can we lock that poll, please? I think I'm still seeing a couple of votes. It looks like we have a pretty well-distributed bell curve, actually.
Yeah.
3 to 6, 6 months to 1 year, got about a third of the votes. And then 1 to 2 years for 28%, a little bit less on the other side of that bell, 3 to 6 months at about 20%. So it looks like a bit of a skew with a skew towards the long term with a little with an average of 6 months to 1 year. Bart, do you have any comment on that?
Yeah. I think it's actually an interesting distribution. It does point on average at the U shape, but it also points at the differences between sectors. And again, I want to emphasize there are really some good comments and questions on there. And we cannot answer them all, but we are actually writing up some of this. So all your inputs are really helpful for us because it helps us to think through. Some industries will be able to recover faster. My expectation is that we will see sectors in pharma, sectors in other areas that can open up relatively fast and perhaps see a little bit of an upside given the need for the kind of products and services that provide. They could recover within 3 and 6 months. But I think for most of us, it will probably take between 6 months and 1 year. And then there will be companies that, are actually, if you talk about 1 to 2 years, you're almost moving into that L shape. You lose something and you do not have a lot of pent-up demand. I mean, a lot of services, for example, what you're giving up now is not coming back later in the year. You can perhaps recover to your business plan that you had before, but it doesn't mean that you can gain back to what you had. So it's very important to think in terms of your growth rate, which may be great, but your level may still be lower than where you were before. So that's a good way to think about it.
Klaus, did you have any comments you wanted to pepper in as well?
Sure, yeah. I think the main difference between the L or U or V-shaped scenario is how will people, consumers, business, how will they view it? Will they see it as a one-time shock and we'll get back to normal quickly? That would be a U or a V shape, but it would be an L shape if people see this as, oh wait, this can come back if uncertainty really is pervasive. That I think is the main driver of the both scenarios.
Ilaria, if you're with us, it'd be great to hear you chime in as well. Do you have any thoughts on this before we actually launch the Europe section?
Well, perhaps one thought, and not really on the poll, which is surprisingly normally distributed, but more on the on this issue of the L-shaped versus V-shaped. And well, it's of course hard to say, and we are doing our best to make the scenarios and all. But I think the idea of an L-shaped growth pattern after the COVID-19 crisis is a way points to the fact that some things might change in the long term, and so it is worth perhaps thinking about how much behavior will change and how much consumption patterns will change in the future. And perhaps I think that's the best connection to the idea of an L-shaped scenario. We should perhaps elaborate on that later. But let me go to my slides and move to Europe. So we are doing our best to follow this, but it's not easy because, of course, real data come with a delay. And the best we can do right now in terms of hard numbers is to track confidence data. So what you can see here in this slide is economic sentiment, so business confidence basically by different type of industry, and then also by country on the right-hand side. Now, these are March data, so they capture to some extent a declining confidence, but most likely not the full declining confidence in the sense that countries in Europe went into lockdown at different stages. So think that the whole thing, it feels like ages, but it all started in the last week of February in Italy. So what you see here in the March data is to a large extent sort of underestimation of what we're going to see in April. This said, you can already appreciate some declining confidence among businesses, and especially in the service sector. What I find interesting is that if you decompose the PMI data, the Purchasing Managers Index, between services and manufacturing, you can see a gigantic decline in services in Europe, but the manufacturing sector had a relatively smaller decline. And I'm curious to see whether this big difference between the two main sectors of the economy will actually change or remain the same as we get the April data. On the right-hand side, you can see economic sentiment by country, and so in blue, the blue bar indicates the data for February, then the orange for March, and then in gray, I put there the minimum of the last 20 years, just to give an idea of how lower we might see confidence perhaps in April. An interesting fact is that in all of the countries, the gray, the minimum, was touched around the beginning of 2009. And I will come back to this comparison with the global financial crisis. But let me go to the next slide first, where we have done the same exercise as you guys did in the US, where we try to translate the scenarios into actual figures. And I'm not going to repeat everything because I know we don't have a lot of time, but we have a lot of slides to show. But basically what you can see here is a decline in the economy that goes from more or less minus 3% to more or less minus 7%. And in any of these cases, we have a V, a W, or a U-shaped recession. The important message here is that if you think about the economy at the end of this year in simple euro terms or dollar terms, we will, under any scenario, have a smaller economy at the end of this year than at the beginning of the year. And that basically means that we will have more people unemployed, lower levels of confidence, but hopefully to some extent closer to minus 3% than to the minus 7%. Now, I've done an exercise in the next slide that I think everyone is doing, which is comparing with the global financial crisis, so with 2008 and 2009. And it is an interesting exercise, but we should be aware of the differences between the two shocks. So it is a useful exercise because, of course, it gives us an idea of how low all of the variables for looking at the economy are going. And so, for example, we have done the same comparing the PMIs. We've done the same. I did the same in the previous slide, looking at confidence levels, business confidence level. We will do the same with consumer confidence. So it's useful because we all have a memory of that crisis to go back and see, okay, how much deeper is this? How does it compare to the biggest shock we have a memory of? No, this is useful up to a certain level because the two crises are actually very different. First of all, I would say it's probably certain that we will end up with a deeper recession than in 2009. If you want to have a comparison, the decline in GDP in 2009 was in the range of -3%. So -3% is currently our best case scenario of the four that we have. Also, these are very different shocks. So if you remember, the manufacturing sector was heavily hit 12 years ago, but now we currently see that this crisis involves much more, and to a very large extent, the service sector more than the manufacturing sector. This is a supply shock for the time being. It will come on top as a demand shock. It is a gigantic difference in terms of supply chains disruption. So we observed a decline in trade in the past, but what we see now is a major supply chain shock that will definitely affect supply chain strategies in the future. And also, and this comes back to the L shape versus other shapes, what you see here is that indeed the 2009 crisis led for actually a long period of time to an L-shaped shock. Which means that it took a very long time for the economy to return to where it was. It took more than necessary for sure. Whereas what we expect right now, it's not that. We expect a recovery, and we can debate how long that will take, but hopefully it takes shorter than what happened in 2009. I only have one last slide. In the next slide, you can see some thoughts of what is coming, and some thoughts there. As I said, one thing is definitely everything of supply chain strategies. The other issue which I think is important is the fact that is the labor market. So we are trying to make some estimates, and we will have them in the coming days and share them as soon as possible on what this means also in Europe in terms of unemployment. Now the bet is that the unemployment shock in Europe is smaller, and it's smaller thanks to the fact that it's much more common in many European countries to have schemes like the Kurzarbeit or the Chômage technique, which allow not to fire workers. So this means that workers can be called back as soon as restrictions are lifted, as soon as demand picks up very quickly, and possibly that will not lead to permanent disruptions to the economy and to businesses. There is a lot of things happening in the policy domain, and we don't have time to talk about this, but I think we should all keep in mind that we have two levels of policy debates, and that will have an impact on the economy and on the recovery as well. So we have the national level where countries are doing a lot, have been doing a lot in just 1 month, and then we have the EU level, the ECB level, where again it takes longer to agree on things. And that, as we learned in 2012, can have an impact, of course, on the recovery.
We want to talk about China as well at this
I'm going to stop here.
Before we do, I wanted to maybe touch on an audience question. We have a question here. I also would like to hear about the U.S. housing market. Does an inflationary outlook to the U.S. make housing a good investment even at current prices? That's a pretty tricky question to answer. There's a lot of moving parts here. On the one hand, we have, in terms of the amount of housing that's being added to the market, low interest rates are helpful for builders. But again, this demand shock among U.S. consumers is going to impact confidence, impact consumers' willingness to go out and make major purchases, such as houses and cars. So I think in some ways we could see a bit of a lapse in demand for housing, which could, of course, negatively impact prices. Bart, I'm curious as to see if you have any thoughts on this as well.
Yeah, it's great questions, because so many people are talking about this, and we will do a little bit more work around this. My views are sort of two very important parts. First of all, what's going to happen to interest rates and inflation, and the second, what's happening to demand and supply here for housing. So on interest rates and inflation, our view is that it's likely for interest rates and inflation to be low and remain low, and perhaps even get lower. Of course, this is on the assumption that this is becoming much more a demand kind of crisis. If the supply constraints will be serious over time, that could actually lead to upward inflationary pressure. So it's not unthinkable that we have upward inflationary pressures, but I do think that there is a small probability to that. It's more likely that there will be just huge lack of demand. But on the housing sector itself, I think the more important thing is that the thing is just locked up. There will be no supply because people are not going to move. Who's going to put their house on the market in this situation? And where are you going to go? And there are sources of demand because people will not want to move. Of course, normally, when you get out of a crisis and you go into a recovery, people are going to move and buy new houses. They go get a job somewhere else. And I just do not think that is very likely. So I think the housing market will get locked up in the next couple of months, and that the overall effect of that usually is that prices and values of homes will be very modest, and that the prices of new homes will be quite low, but it will not help to accelerate the demand very much.
Thanks very much, Bart. So let's go ahead and maybe just spend a moment or two talking a little bit about China. This is not the first time, of course, that the Chinese economy has had to grapple with something like this, although certainly this is the most extreme case. I'm, of course, referencing the SARS outbreak that we saw in early 2000s. We envisioned that the impact of COVID-19 to be a lot stronger and more dire on China's economy than SARS was. For one, there's a much larger distribution in terms of the number of infections that took place. Another interesting sort of element to this is that the services sector inside of China is a lot larger than it was in 2003. So we talked earlier on about the supply shock versus the demand shock. China has already sort of been in the throes of the supply shock. Companies are shut down, factories are shut down. And now it's about the Chinese consumer coming back online and feeling confident to spend once again. That's going to take time. Because China's services sector is much larger now than it was 15 or so years ago, it's going to take a longer time for the economy to recover. Another hurdle that China is going to be facing this time around is that the global economy was impacted by this pandemic in a much stronger way than was the case with SARS. China's economy, of course, is less exposed to foreign demand vis-a-vis exports. It's less export-oriented than it was 15 years ago, but it's still a sizable part of China's economy. So if your customers downstream in the U.S. and in Europe and in other parts of the world are in the throes of this pandemic and their consumers are losing their jobs and aren't demanding as much, of course, that's going to have an impact on China's economy as well. So, you know, for all of these reasons, we're expecting a pretty hard hit on China's economy. We don't really expect to see a strong recovery from this the way that we perhaps expect to see in the U.S. and in Europe. So more of a longer, drawn-out process. One of the other interesting elements to this that we're going to see, I think, over the coming months. In 2005 or so, and even after the financial crisis, China deployed a vast amount of stimulus to prop up the economy. It was really just mind-boggling how much money that they injected into the system. This time around, that's a lot less likely. For one, there are fiscal constraints inside of China. They're still, in a lot of ways, coming to terms with the massive amount of stimulus they did 10 years ago after the financial crisis. So they're not able to deploy as much capital because it puts a stress on their financial system. The other part of it is that actually China's economy is a lot bigger now than it was a decade or so ago. So you know, in order to move the needle in the same way that they did after the financial crisis, would require even more capital than they used at that period. Bart, I see that you want to make a comment.
Yeah, well, it's actually more a question. I think there's a lot of debate in the media about whether China can give us any guidance to what might be happening in the rest of the global economy. And I think there are two parts to that. One, of course, is the Chinese economy is very different. It's at a higher growth trend than most of the Western economies are. So if you're at a higher growth trend, you're likely to get back faster to that growth trend. The other thing is, going back to the COVID crisis itself, is the measures that the government can take and the response of people to adhere to measures that the government does take. So, containment measures and social distancing, the ability of China's government to really execute that and get people to respond to that is much stronger than in Western countries. For example, I know in Europe there's now a debate about maybe we should have apps on which we can check whether people are in touch with other people who have had the virus or not. And of course, there's huge issues around privacy debates that are typically not be had in the case of China. So do you have any comments both on is the recovery in China anything comparable to what we're seeing here, and the response to the COVID measures that the governments are taking?
Sorry, Bart, I got a little bit distracted. Would you mind repeating the question? I missed that.
Yeah. So my question was, there are two things here. One is, can the economy in China come back as fast as, can the economy in the rest of the world come back as fast as China, because China has a high growth trend? And secondly, can COVID measures to continue social distancing and other containment measures really be executed as aggressively in Western economies as is the case in China?
I mean, the political systems in China versus the political systems in places like Western Europe and the U.S. are very, very different. They're much more centralized, much more authoritarian, if you will, in China. So when the government says stay at home, people stay at home in China. I live in Connecticut. The local government has said stay at home, and I see people walking around on the streets and on the beaches and things like that. So clearly there's a cultural and a sort of government difference in terms of the ability to enforce social distancing measures. In terms of the bounce back, China's economy was, as I think you mentioned earlier on, was slowing going into this. It was growing at a higher rate than we've seen in places like the U.S. and in Europe, which are more mature economies, but there was a gradual slowdown that was occurring inside of China. So I am a little bit hesitant. I don't believe that China's economy will bounce back and go back up to whether it's the official growth rate numbers that we had previously seen, like 6% or so, or possibly we do our own alternative estimates of China's GDP, which is showing about maybe 3%, 4% growth walking into this crisis. So I don't expect to see a big pop and a movement back to those previous growth rates in 1 to 2 years' time. It'll be more gradual. I do want to just do a quick overview on some of the projections that we're currently making for China. We have not yet implemented the same kind of industry-based forecasting that we're using in Europe and in the U.S. to analyze this crisis. But that having been said, we're still expecting to see a pretty sharp slowdown in the first quarter. These are year-on-year growth numbers, so we're looking at about a 15% year-on-year contraction for the first quarter of this year, and then more of a gradual uptick. As again, the supply shock is sort of what the Chinese economy was grappling with at first, but that demand element, whether it's demand locally from Chinese consumers or demand abroad in terms of exports, that's going to take longer to come back as well. So this is sort of the shape of the recovery that we see at present. And of course, in terms of annual growth rate, we see a zero growth rate environment for China in 2020. Again, that's using the official numbers that NBS publishes. According to our alternative numbers, that could even, and we're currently in the process of trying to translate these into our alternative metrics, we could actually see even a growth contraction in China for 2020. But we do have a couple of other areas that we need to touch on. Klaus, I wanted to spend a moment or so talking about emerging markets. Would you talk a little bit about other parts of the world that we haven't touched on quite yet?
Yeah. I'm mindful of the timing, so I'll keep it short. But as I mentioned in the beginning, there are, besides the perhaps upcoming health shock, there are already severe economic shocks going on in most emerging markets and developing economies, like the fall in commodity prices. We've seen prices of crude oil drop below $30. They're now a little bit higher, but it's very uncertain, of course. But also other commodities have declined. There's a stop in manufacturing trade that's really hurting them. And of course, on the financial side, there's a lot going on. Private market flows have stopped, and people have been pulling out of money. into more safe assets like U.S. treasuries. And of course, there's also a huge reduction in the availability of cross-border dollar financing. So they're having huge financial issues. Now, on how that translates into economic impact, I think that will differ a bit by countries. You have countries which have more cushion funds, like the oil exporters, who have a lot of accumulated stocks of accumulated reserves. Now, they may have some legal problems making use of them, so there needs to be some changes in governance or in the legal system to make use of that. But in any case, they do have they have a better chance of cushioning this in that sense. And then of course you have the Asian current account surplus countries like Taiwan and Korea, but also Japan, who have a stronger cushion in that sense. And then of course countries who don't really have these cushions, and I think there was a question also on Latin America. I think that a lot of the countries there fall in that category. For them, they are probably much more reliant on institutions like the IMF or debt forgiveness from private investors or other investors. So we've already seen that I think over 80 countries have asked the IMF for help already in terms of getting their financial systems back up. So I think, and now it's too soon to say what will happen, but of course it's a major risk, and we'll have to watch it closely. But it really depends on the global response in that sense. I guess that's my point.
Thanks very much, Klaus. Sorry we ran out of time. I know that you had more to say. We have a lot of fantastic questions that we're not able to get to. I wish we were, but 1 hour constrains the number of topics we can tackle. We do these webcasts, Economy Watch, every month, the second Wednesday of every month. Next month, we're going to be actually discussing the impact of COVID-19 on the U.S. labor market. I'll be joined by some fantastic guests to peel that story back as well. So we'll see you in a month's time. Again, the Conference Board is producing some fantastic research and insights on COVID-19, the impact on the economy, the impact on human resources, on human capital. So make sure to go to our page on this. You can simply Google the Conference Board and COVID-19, and it should bring you to our landing page. Again, thanks very much for joining us. It was a great webcast, and we look forward to seeing you again in a month's time. I'm Eric Lund, and it was a wonderful morning. Thanks so much.